All right, good afternoon, everyone. This is Joe Bicella here at Chaikin Analytics, and I'd like to welcome you to our presentation of Building Portfolios That Beat Robo Performance, how to use ETFs to build a sector-based portfolio. Throughout our presentation, please submit your questions using the Zoom Q&A window, which you can access in the upper left-hand corner of your screen. As a reminder, this webinar is being recorded, and a copy will be sent to everyone who's registered. Now, presenting today is Marc Chaikin, founder and CEO of Chaikin Analytics, who is known for developing the Chaikin Power Gauge rating. Presenting along with Marc is Carlton Neel, COO of Chaikin Investments. Carlton spent 5 years as a VP at JP Morgan after having worked alongside market guru Dr. Martin Zweig at Zweig Mutual Funds for nearly 20 years. Now to get us started, here's Marc Chaikin.
Thank you, Joe, and welcome everybody. Today's webinar is very tight because we're mindful of your time, but I think it's packed with very useful information. We're going to look at ETFs in a very unique way, the Chaikin Power Gauge and Power Bar, and then we're going to show you how to use ETFs to find individual stocks in a very disciplined way. So just a tiny bit of my background: 50 years on Wall Street. For 45 years, I've been using technical analysis along with fundamentals to create rules-based portfolios for individuals and institutions. Along the way, I headed the options department at a regional firm called Tucker Anthony and R.L. Day that many of you may know. And I've been mentored by some of the smartest and most successful institutional investors, and I think Carlton will tell a similar story. And the reason that's important is that everything I learned from these mentors, both colleagues and clients, is reflected in our fundamental model, the Chaikin Power Gauge rating. It's really the culmination of my life's work. It's a 20-factor model. It's at the core of everything that we do at Chaikin Analytics, from market letters to advisor workstation, and we're going to go into that in depth so you can see how powerful this tool can be. With that, I'd like to introduce my colleague Carlton Neel, who joined us in January and has become a critical member of the Chaikin team.
Well, hey, Mark, thanks. It's great to be on the webinar with you today. And I got to tell you, it's an amazing thing to be part of the Chaikin team, the enthusiasm here, and just generally the intellectual property that you've built over the years with Chaikin Analytics, I think is spectacular. I did indeed spend 5 years at JP Morgan and cut my teeth there in the early 1990s, but ultimately wanted to be part of a smaller and more entrepreneurial place, and was really fortunate enough to be hired by the legendary market guru and investor, Martin Zweig, Dr. Zweig. And Marty and I worked side by side for nearly 20 years. I built a number of portfolios, managed mutual funds with him, and other institutional products. So hopefully today, alongside with you, I can work to hopefully garner some wisdom for the audience on how I used the Chaikin Power Gauge, Chaikin Analytics to build and maintain my own portfolio here.
I noticed you put running the Zweig mutual funds. Marty Zweig was also a friend of mine, and he was an avid runner. I think he had a string of what?
He did. I think he went almost 8 years. His minimum was he had to go a mile, and that counted as a run. And obviously he was an avid runner, and I think he went almost 8 years with his streak. So it was quite remarkable. He was a remarkable guy.
Well, we've got a streak of 8 years going since we started Chaikin Analytics. I am not a runner, so we'll leave that to people with different point of view. But we have been fortunate to get a lot of media exposure for the Chaikin Power Gauge rating in places like Barron's, CNBC. There's an article in Forbes that's coming out shortly about Mexico, where they quote me talking about the EWW, the Mexican ETF. So media, as well as institutional investors like Paulson Hedge Fund, Soros, and Fidelity Investments, have started using the very tools that we're going to be talking about today, and they have been using them for well over 3 years. In the next 45 minutes, we're going to show you how to position your portfolio for profits. We're going to start out by talking about what to expect in the markets in the month ahead. both interest rates and stocks. Then we're going to segue into how to find winning sectors, industry groups, and stocks. Most importantly, part of the process of building a profitable portfolio is knowing what sectors and individual stocks to avoid. And we're going to show you how to build that portfolio using a very disciplined approach. And then as a sort of added bonus, we're going to show you how to use ETFs to find strong stocks for those of you who build portfolios from the bottom up or who enhance your ETF allocations for clients with individual stocks. This is a really powerful and unique way to use ETFs to find strong stocks. So I'd like to start out with a question that is on everybody's mind. I read investment news every day on the internet version and then get it in my mail. And in almost every issue, the concept of robo-advisors come up. So I'd like you to ask yourself whether you're concerned about the impact of robo-advisors on your practice. If you are, type a big R into the question box, please. And I see that a number of you are at least thinking about robo-advisors. There's someone who says, wait till they find the next bear market. I agree with you on that one. This webinar is all about how you can add alpha and make robo-advisors irrelevant, because as advisors, you have the edge that you're talking to clients, you're holding their hands during difficult periods, but at the end of the day, everybody's seeking alpha. And we're going to show you how you can generate alpha in both ETFs and individual stocks. And when we start talking about the market, I'm going to call this a Yogi Berra market. It ain't over till it's over. You've been seeing a lot on CNBC and in the press on how the market is overvalued, that we're approaching a bear market, a recession is just around the corner. Big investors like Tudor Jones, long-term track records, are bearish and not shy about talking about it. I think this market has legs, and we're going to show you why. So we're going to look at market direction, the trend of interest rates, and then the trend of corporate earnings. Now, Carlton, I know you love this slide, so I'm going to let you jump in.
Yeah,
here.
I really do. The other comment that I'd make is I read somewhere that somebody called it the TINA market, T-I-N-A. There is no alternative. And given what's been happening in interest rates and whatnot, certainly this is an apropos picture of what's happening, because it shows net how earnings ultimately drive stock prices. You can see in the most bullish buckets, which are the top two of this 4x4, rising earnings are the key component to a bullish market. And even though we are headed into higher rates, we've got a Fed that's telegraphed that they're going to raise rates. We've seen the TLT, which we'll show on a future chart, that's been generally showing higher long-term interest rates in the US. However, as you can see in 2016 and 17, despite higher rates with the rising earnings, we've just come off of earnings seasons that continue to show good, strong earnings. We are in a bullish phase of this market.
And I think equally important is the fact that we've got a first quarter that's ending right now in terms of earnings reports, and you've got a lot of top-line revenue beats. Companies for the first time in 4 years are surprising in terms of sales at the top line. That's not easy to achieve. We know that you can achieve rising earnings through accounting techniques or cost cutting, but higher sales really give a bull market legs, and that's what you saw in the first quarter earnings reports that are winding down this week.
Yeah, that's an excellent point.
In addition to that, you have a lot of company management that are using very positive words in the conference calls and raising guidance. This is an earnings-driven bull market. We've gone from a Fed-driven bull market with zero interest rates to an earnings-driven market, not just in the US, in my view, but worldwide. And I think this is a very powerful scenario. And let's take a look at a couple of charts here.
Yeah, this is the TLT that we were just speaking about, Mark, where it's basically the 20-year plus iShares US Treasury market. And you can see it's kind of been going sideways for a while, although really since the non-farm payrolls last week and the continuation of the strong earnings pictures you just mentioned, you can see that interest rates have, once again started to move up slightly.
Yeah, and we see a different picture than you're hearing about on CNBC. In fact, Lloyd Blankfein from Goldman Sachs is on CNBC as we speak, saying that this economy could accelerate. It could be much stronger. So, what does a stronger economy do if you've been growing at 2% a year GDP and suddenly you get it up to around 3%? It creates a whiff of inflation. And it also results in higher interest rates. So if the Fed is taken at their word, and Carlton's mentor, Marty Zweig, said 2 ways you make money in the market is to watch the Fed and listen to the market. So the Fed is telling us that they're going to raise rates, probably another rate hike coming in June, particularly as Carlton said, in light of the non-farm payroll report last Friday. So in a climate of rising interest rates, do you want to be in bonds or do you want to be in equities? And here's the 1-year chart of the Select Spider Sector ETF, the SPY, which, as you know, is the most actively traded instrument in the US markets. And we've broken out of what was a very powerful uptrend channel, pulled back below it, but here we are again, banging up against 2,400 on the S&P. And although Chaikin Money Flow, which is our supply-demand indicator that's been in the marketplace since 1982 on all your quote terminals, Bloomberg or Reuters, stockcharts.com, and so forth, although it's not as strong as it was in the early phases of the move, we still see positive money flow even as we're getting overbought. And I think one of the unknown facts about this bull swing from February of 2016, and as we'll see on the next chart, is that pension funds and endowments are underinvested in stocks and they're overexposed to bonds. So if we go back to that bund chart, is this the right place to be? I mean, you can see from the Chaikin Money Flow that
They're
there was a
buying.
lot of buying.
Yeah.
Exactly. And you've been in the institutional money management business. You've dealt with pension funds, Carlton. When does that shift take place? When do they realize that they've got a problem?
Well, I think that looking at that chart right there lends me to believe that they haven't been convinced yet, and it probably means that there's more legs to go in the S&P 500. Marty's other thing that he always said is beware the crowds at the extreme. It seems like we've gotten a little extreme buying going on in the bond market, whereas when you look at the equity market, as this chart of the S&P shows, what was really remarkable is I think you and I had done a webinar shortly before earnings season, which is kind of where that dip was in the S&P about a month and a half, 2 months ago, and that turned out to be a tremendous buying opportunity. So I think that there are a number of cross currents going on in the market, but one of the things that I think you'll show on the next chart is that another Martyism, the trend is your friend. Here we go. Stock market since, as you mentioned, February of 2016, up roughly 25%. What usually happens after a nice rally like that? Well, the rally continues. So you can see most of the time, you can add 19 and 36 of the 72 cases, you've actually been up after 25% gain that we've just had over the last year and call it 3 months.
And that's more than 75% of the time. So if you're looking for the next bear market based on valuations or based on the fact that we've had 8 years of a bull market, and a recent rally of 25%, the odds don't bear it out. There's a chart that I didn't put in here about leading indicators that came out of Charles Schwab this week that showed that every recession and thus every bear market since 1965 has been preceded by a dip in the leading indicators, and leading indicators are on the rise. So from all accounts, whether it's technical, statistical, or economic, this market has legs. Now, why is that important? Because if the market's moving higher, whether it's 5%, 10%, or more, you've got to find the right places to be. So we've sort of identified an interesting scenario here. Rising interest rates, which, as we know, are very, very good for the financial sector. That's why we had such a huge rally even before the election, but after the Trump election, because if all these Trump agenda items or even part of them get enacted in Washington, there's going to be inflation, there's going to be a demand for capital, there's going to be a pickup in economic activity. So this chart shows us over the last 75 years which sectors do well in periods of rising interest rates and which sectors do poorly. So the sectors on the bottom left, financials, industrials, technology, material, and energy, typically do well in periods of rising interest rates. These are your cyclical stocks that benefit from a stronger economy, and obviously the financials benefit from rising interest rates. The companies and the sectors that do poorly in periods of rising interest rates are the defensive interest rate sensitive stocks, utilities, telecom, consumer staples, and healthcare. And consumer discretionary is an outlier. Now,
Well, because it's
yeah,
such a broad category, it's hard to define exactly. Consumer discretionary is really a big sector, and it's hard to judge exactly why that is there. But I think you make an excellent point here, Mark, on the interest rate sensitive sectors. When bond rates were going down, people were starting to use utilities, staples, and healthcare as a bond substitute. With the higher dividend yields that those segments of the market typically offer, they were going into those areas. We've seen kind of reversal with the bond market weakening on occasion over the course of the last several months into areas like financials, industrials, and technology, which I think you'll point out later in the presentation about how to find great stocks in the areas with the tailwind at your back.
now the two outliers here are energy and healthcare. Energy, because the price of crude oil has come down and sort of stabilized in the mid 40s in terms of West Texas crude, which had a very, very big rally off the bear market in energy in 14 and 15, as we'll see later. Energy is an outlier, but clearly financials, industrials, technology, and materials have been leading the way since the presidential elections in November. Healthcare has also done well, as we'll see, and I think part of the reason there is that every cycle is different, although these are averages, but healthcare is very politically sensitive. And when we had the whiff of a Clinton victory, Hillary Clinton was much more vocal about healthcare costs and drug pricing than even Donald Trump. And so healthcare stocks were very nervously sold ahead of the election. And as we'll see now, many of them are making new highs. So, but the basic trends persist, and it's important to know that. But we give you a way to sort of validate that in Chaikin Analytics. So we're talking about a lot of information. Even before we get into sectors and individual stocks, we've zeroed in on one of the biggest problems that we face as investors, and that's the information overload problem. As advisors, professional investors, you're talking to your clients, you're processing fundamental research from your firms, or you're generating it yourself, when really what you need to be doing is going out and prospecting and bringing in new accounts, building up your practice. So we need an answer to the information overload problem, because it can just overwhelm us. And at Chaikin Analytics for the last 7 years, the power gauge rating, that 20-factor model that reflects the mentoring that I got from successful institutional investors and analysts, helps you cut through the clutter. On the right is the kind of data that Carlton used to deal with.
Yeah, you talk about information overload, Mark. Over the years, I can't tell you how many analyst research reports I've either read, whether they're my own analysts, Wall Street research. I've looked at spreadsheets, analyzed data, and there's absolutely no doubt in my mind that the elegance and the beauty and the power of the Chaikin power gauge is that it does cut through the clutter and give you a rating of a stock that's very clear and understandable. And as I think you've pointed out, it distills how Wall Street thinks down into one convenient location to find the information.
Now, there are a lot of quantitative models out there. It's very interesting. We referred to this as a quantamental model because it has quantitative and fundamental factors, as we'll see in a minute. But Morgan Stanley launched a quantitative model about 4 years ago, a couple of years after we were in the marketplace, perhaps 3 years ago. They don't make that model available to the advisors. They make it available to their institutional clients. So if you have Morgan Stanley advisors on the call, I don't think you've seen the quantitative model in a form like this where you can very quickly use it to validate an idea or reject it. Personally, when I go through Barron's on the weekend, I go with my iPad version of the power of Chaikin Analytics, because if they're writing up a positive story on a stock with a bearish power gauge rating, that's just a waste of my time because I believe in the model. On the other hand, if they're talking about a stock like Lam Research, which they were about 3 or 4 weeks ago, and it has a bullish rating, then I want to learn a little more about it just so I have even more confidence to talk about it on webinars like this. So as you can see, we've solved the information overload problem to the extent that you believe in the power gauge rating. So a good part of the next segment of the webinar is to convince you with proof that's relatively indisputable that the power gauge rating works. But our solution to the information overload problem is Chaikin Analytics for iPad and desktop. And I've always felt, starting with my days heading up an options department, that traders and investors need an edge. And we provide what we call the Chaikin directional edge by combining fundamentals with technicals into a quantitative model on 5,000 US equities and ADRs, and then providing very disciplined, rules-based buy and sell signals to help better time exits and entries. So if you're an active portfolio manager, and I had the good fortune to be invited to address the NAME conference, the National Association of Active Investment Managers in Denver a number of years ago. One of the slides I used there showed that institutional investors that use technical analysis, therefore active traders, actually outperform their fundamentally oriented brethren. So I think it's important to combine technicals with fundamentals. We know that fundamentals drive the market, and we're going to see why in a minute. So we've encapsulated all of this into a very disciplined methodology. I know Carlton used this when he built or reconstructed his retirement portfolio when he joined us in January. And Carlton, you may want to speak to that process before you dive into it a little later on.
For sure. I think the key thing here is that every investor needs to have a plan, and you need a disciplined methodology. After managing money for over 20 years, I realized that you need to have a discipline. Obviously, you need to believe in your discipline, but then you need to stick to it. And the thing that I have been really enamored with the analytic tool is that I've been able to build a portfolio utilizing a very disciplined approach that I have confidence in, because I know where I can move my money. I know when a stock is very bullish that it has a very high chance of outperforming, and when it degrades and goes to neutral or even bearish, it's time to get out of the stock. So it also even builds in a sell discipline, which for many people is one of the hardest things. I think one of the dirty little secrets out there about money management is that a lot of fundamental managers almost get married to ideas. I mean, I could think of one, Valiant. How many portfolio managers out there believed in Valiant? It was a darling of the money management world, of the hedge fund community, and it was an absolute disaster in the end.
And as we'll see in a little bit, when we look at the energy sector, Kinder Morgan would fit that description as well. How many?
And energy in general has been that way for sure.
Yeah, I mean, Kinder Morgan, because of that huge yield, 20% at one point, just seduced the analysts. Barron's finally, sort of burst the bubble there, and fortunately the power gauge was bearish at the time. But this pyramid starts with the power gauge on top, and then sector and industry group strength is extremely important. At the bottom, you really only need two technical indicators: money flow to measure institutional buying and selling, and relative strength, because if you're going to add alpha, you want to outperform the market. So you want to be in stocks, as many institutions do, not just momentum investors, that are beating the market. It's the value investors who have patience, like a Warren Buffett, and we'll see that even that can go awry, that really get hurt by sticking with stocks. But stocks that are beating the market, that have solid fundamentals, they're not always momentum stocks. They're the ones that outperform. So we've identified two patterns that encapsulate that discipline methodology, that plan that Carlton was talking about. The first one is classic Chaikin bulls. I'll just read off the bullet points, and then Carlton will analyze our example here because it happens to be one of the stocks that he put into his retirement portfolio. The power gauge is bullish, meaning that the fundamentals are strong. The stock is outperforming the market, and Chaikin Money Flow is green, indicating that institutions are buying the stock. They're accumulating it.
So what I looked at, Mark, when I was kind of going through, I will show everybody the screening tool that I utilized. But back in January, when I was building the portfolio, I looked for some stocks because obviously the market had been up quite a bit, and I looked for names that actually had some kind of a pullback or an ability to buy the stock on a little bit of a oversold condition. So this is an oversold buy here that happened in AMAT in Applied Materials, where you saw all the other factors being excellent in the stock. Generally, as it shows down below, the market agrees with the model. We were seeing that the Chaikin Money Flow was still fairly solid. We were very happy, obviously, with the very bullish rating that the stock had, and it was taking a little bit of a pullback. So this was an opportunity to enter a name that I felt was in an area that looked very good.
And this is really what we look for, and you'll see that we've encapsulated this and given it a name and sort of associated it with one of the best investors in the world. So the complement to that is what to sell or avoid, and these are classic Chaikin bears. Power gauge rating is bearish. Stock is underperforming the market. Chaikin Money Flow is red, not green, telling you that institutions are selling the stock. And the poster child for that has been Under Armour. Everybody is familiar with this trendy athletic apparel stock, footwear as well, trying to compete with Nike by luring away expensive athletes to endorse their products. But the bottom line is the fundamentals didn't match up with all the enthusiasm on Wall Street. So the power gauge rating has been bearish, primarily because the fundamentals, the value metrics were very stretched, and we'll see what they are in a few minutes. So the power gauge rating was telling you beginning in mid-July that the stock was not attractive from a fundamental point of view. And look at how relative strength has persisted. Under Armour has been underperforming the market for over 15 months. And can you see the institutional selling looking at the Chaikin Money Flow? It's very powerful math, but it's very simple display. When it's red and stays red even when the stock rallies, it's telling you that institutions are looking for every opportunity they can get, and typically that's associated with negative earnings surprises. Stocks that look like this, bearish fundamentals, institutional selling, underperforming the market, typically negative earnings surprises. Even when they get a positive earnings surprise after a string of 4 or 6 negative earnings surprises, the relief rally doesn't last very long because there are plenty of people who are happy to get out of the stock on strength. So we're talking about the Chaikin power gauge rating, and the display is very simple. I like to say that the Chaikin power gauge rating is like a Chevrolet with a Ferrari engine under the hood, because there's a lot of number crunching, a lot of very, very solid math and solid thinking that goes into it. And although we're not going to talk very much about earnings season specifically, you'll see examples of how the power gauge can help you during earnings season, a time when a lot of people are reluctant to make investment decisions. They're concerned about volatility, and you need a helping hand, and you need a GPS to really navigate earnings season, to stay sane and also have a good dialogue with your clients that's proactive as opposed to reactive. So we have a partnership with a gentleman named John Carter. He has a company called Simpler Trading. He's one of the great pure traders in America, but he also believes in fundamental analysis. So when he first became exposed to the power gauge rating, he called it an awesome meter for stocks because it combined 20 plus technical and fundamental factors to anticipate a stock's potential. And we're very proud of this endorsement because there is no better trader or analyst than John Carter in the market today. So let's look at those 20 factors that got John so excited. These are the 20 factors that I distilled down from 200 in a one-year research project that ended in September 2010. This model was locked down. The weights were locked down. They're variable. Not each factor has the same weight. Grouped them into 4 components so that they made sense. And this really, as Carlton said, reflects the way the market works. In fact, someone who independently evaluated the model, Mark Gerstein, who used to be the Assistant Director of Research at Value Line and head of Reuters Research, said that the Chaikin Power Gauge works because it's based on how the market works. And these are the factors that institutional investors look at every day. Now, I like earnings surprise and earnings estimate revisions. One leads to the other. I learned that from one of my mentors, George Douglas at Drexel Burnham in the mid-'80s. And I've been following earnings surprise since I started in the business in 1966. Initially, you got a publication from Standard & Poor's once a week telling you what analyst estimates were doing and what companies were reporting. Now, I know Carlton has a different bias based on his particular investment style.
I do, and one of the things that you can screen for, and the thing that makes the tool even more powerful, is if you decide that you want stocks that particularly have something like free cash flow, which has always been a metric that I have looked at. I know it's a Warren Buffett one, as you'll see shortly. I'm a big fan of Warren, but I would not want to have something that's a single factor model. I think the fact that you've built in earnings surprise and that the Chaikin Power Gauge utilizes a number of these weightings and these factors lends a lot more power to, as you've suggested, to work the way Wall Street works. So you can have stocks that are surprise after surprise until, as you pointed out, in Under Armour, finally the analysts caught up, and the latest one was an earnings surprise to the upside, but yet the stock is still not behaving well because many of these other metrics are probably rather weak. So I may prefer looking at free cash flow as one of my metrics, but I'm very happy that all these things are part and parcel of the way the power gauge analyzes the stocks.
So what's important to realize here is that financial metrics are 35% of the model, which is 85% fundamental and only 15% technical. And the 2 most important factors in the financial metrics component are free cash flow and price to sales ratio. They have a sort of heavier weighting, much heavier weighting in the model. So the model has a sort of great foundation, and then it zeroes in on much more sensitive factors. And that's sort of the way I think investors at the institutional and advisor level have to look at the world. You have to have a solid base, but then you have to be more aware of what the shorter term influences in the market are and how they affect your portfolio.
It's the old price is what you pay and value is what you get. And it's nice to have both some valuation metrics, as you point out, but also growth and more growth oriented and surprise oriented expert opinion type of factors that are built into a system that allows you to distill, the thousands of stocks that you can choose from into a much more elegant solution of figuring out where to go in the market.
It's sort of Warren Buffett's concept that in the short run, the market is a voting machine, but in the long run, the market is a weighing machine. And so we have elements of both in there. And we'd just like to give you a couple of proof points, and then we'll move on to some very practical examples of how you can build more profitable portfolios that do deliver alpha. Power gauge rating in 2016 divided up into 5 silos from very bearish to very bullish using the Russell 3000. The average very bullish stock, and we don't take the tails like a lot of other people with models do. Each bucket is equally populated with 428 stocks. We combine the bullish and the neutrals for simplification. Average very bullish stock up 32%, 428 of them at any given point in time. The average very bearish stock, however, was up only 9.5%. That's over a 3-to-1 ratio. So if it's the choice between a very bearish stock or a very bullish stock, typically the odds favor that the very bullish stocks will give you better performance. And that was extremely the case in 2015. We just looked at 2016. The average very bearish stock in 2015 in the Russell 3000 was down 17%. Now, how could that be in a year when the market was basically flat? Well, energy stocks were in their own bear market. Small caps in general were in a bear market. Anything related to energy, whether it was rails, steel, anything that built pipeline, bear market. So the average very bearish stock down 17% in 2015. You want to avoid them. We're going to show you how you can do that. And then one final proof point. Chaikin is partnering with NASDAQ and with New York Life's Mainstay investment subsidiary. We created 3 NASDAQ Chaikin indices 3 years ago: large cap, small cap, and dividend achiever. The goal was to establish a track record that proved that the Chaikin methodology, when applied to a large universe of stocks, could deliver alpha, and we in fact have done that. And the result has been that Mainstay Investments IQ subsidiary, which creates exchange-traded funds, has licensed the NASDAQ Chaikin indices and registered 3 of them, all 3 of them, with the SEC as exchange-traded funds. And the small cap fund will be launched shortly. That's all I can say about it because we're still in the registration period. But hopefully next week you'll see an IQ Chaikin small cap ETF from New York Life, the largest mutual insurance company in America. And this is the performance that got them so excited. The NASDAQ Chaikin indices are rebalanced once a year. They represent a subset of the NASDAQ large cap, small cap, and dividend achiever index. So just looking at the small cap, in the 3 years from April 1st of 14 through the end of March of 17, the small cap universe was up about 20+%. The NASDAQ 1500 roughly equates to the Russell 2000. In that same period, the NASDAQ Chaikin Index, which represented a subset of about 250 stocks out of the 1500 selected by our top-down rules-based approach, was up double that, for almost 44%. So if you wanted an allocation and exposure to small caps, that index, and now an ETF that's soon to be launched, could give you that alpha generating performance. So that's enough of the validation. Let's look at real world examples. So we have a pattern that we call personality changes that very often ties in with those classic Chaikin bull and bear patterns, because it's really critical to know when a stock is changing character, because as Carlton said, analysts and portfolio managers tend to get wedded to their stocks and their opinions. So here's an example. Anthem Health, one of the largest healthcare providers in America, was underperforming the market heading into the presidential election. It was in a sideways to downward trend, and there was a good reason. There was concern about what would happen if Hillary Clinton won the presidential election and fulfilled her campaign promises to clamp down on healthcare costs. And then just after the election, the market heaved a sigh of relief, and healthcare, which had been underperforming, started picking up institutional buying. And the way we know that is through the Chaikin Money Flow. It's green consistently for the last 6 months since the election. But more importantly, the stock started outperforming the market. So Anthem Health has reported 2 earnings surprises since that period. There have been a number of buy signals along the way, and the stock has been making new highs. So this is an example not just of a classic Chaikin bull, of that pattern we call a bullish personality change. Absolutely critical. Now you could find this sort of pattern by subscribing to Investors Business Daily and reading through the newspaper and looking at their tables of numbers from 1 to 99. We prefer to provide all this information in one place so you can get at it easily and see at a glance whether a stock is likely to be outperforming or underperforming the market. Now, we had an example just today of a stock, Hertz Global, car rental company, where you had a bearish personality change back here in November, negative earnings surprise, bearish power gauge rating indicating that the fundamentals are negative, second earnings surprise back here 3 months ago, and then look what happened today after the company reported, after the close yesterday, yet another negative earnings surprise. They lost $1.61 versus an estimate of $1, and the stock, which was already down from 50 to 15, gapped down 15% on the opening, and when I pulled this chart this afternoon was still down 13%. So earnings surprises persist. That's why I said you need a GPS during earnings season, and if a company is reporting a string of negative earnings surprises, it's reasonable to assume that they'll continue to do that. And if that's accompanied by these three factors, power gauge rating for the fundamentals, relative strength to see if you're outperforming or underperforming the market, and Chaikin Money Flow to see what the institutions are doing, you get a really good picture of what's happening. And these earnings surprises will not be surprises. You'll be expecting them, perhaps using options to benefit if you're a more aggressive portfolio manager by buying put options and so forth. But the bottom line is the personality change was the key. You had to recognize it. It came at 30, down from 50. That's okay if the stock is headed toward $10. It's not meant to be precise. It's meant to tell you when the tide is shifting.
Well, Mark, I'll chime in here because you know what big fan of Warren Buffett I am, and one of the reasons I am is that he has always had a disciplined approach to investing. He's got a lot of great quotes. One maybe that he probably should have used a little earlier on IBM, and just as an aside, I would joke that maybe he needs to get the Chaikin Analytics because IBM has not been a good stock in Chaikin Analytics for quite some time. And I think that quote was, if you find yourself in a hole, stop digging. So I was relieved to see that my man stopped digging. But in this particular case, we'll go with his other great quote. They don't call balls and strikes on Wall Street. You don't have to swing at everything. You can wait for your pitch. And what I did when I started building my portfolio, Mark, is exactly, or it was early January, as we discussed, and I started trying to find names that I could include in my portfolio, built a portfolio, but then ultimately, as you had pointed out, we saw that Anthem had reported some very good earnings. I had gone into my own portfolio and started looking at stocks where we could see relative strength buys in areas that were also showing good earnings reports and strength in the overall picture of the sector. And so as we were relating to ETFs and how you can use ETFs or how you could use a sector-based analysis, we've got a lot of great names in healthcare because of what happened in the election. And I looked for a stock that I thought we could include in my portfolio that turned out to be Cigna. Cigna in the same space as Anthem. Anthem had already been doing very well. I thought here was a good chance to find a buy for my portfolio, and that's when I added Cigna. And just as an aside, I also used the discovery engine to do that. So there are a lot of great things that you can do here. Another name that I had bought most recently here was Cognizant. You can see here there was an oversold buy. I think we mentioned earlier some of the things that you can look for in Chaikin. There's a convenient oversold or other buy recommendations that happen on the arrow. If you've got them in a watch list, you can wind up saying, okay, here's a good entry point. Cognizant's in an area, technology, that continues to power ahead. I thought this was a good spot to buy it because it was a name that, as you've pointed out here, generally has been having some very good earnings surprise. Chaikin Money Flow, although it's been vacillating, has generally been in the positive. We've seen more buyers than sellers. And with this pullback, it looked like an ideal spot to buy a stock that's otherwise ranked very bullish, largely because a lot of the financial considerations behind it.
And then look at that positive earnings surprise and the reaction to it in a bull market. You will very often see, particularly when people are underexposed to equities, a very, very strong reaction to a positive earnings surprise. In this case, the stock went up and made a new 52-week high. So I think the reason the Warren Buffett analogy is so important is that we started out by looking at classic Chaikin bulls and bears. Those are the stocks where everything is lined up. That's the fat pitch that Warren Buffett is looking for. When everything is lined up, the odds are in your favor. The signal is just the sort of trigger, the low risk entry point.
It's a great entry point. That's right. I mean, if you're looking for your pitches and you're smart about it and you utilize the process well and you have a disciplined approach, you can wind up finding those fat pitches in this market.
And here's another way that Carlton screened, and this actually embodies the disciplines that he likes. Why don't you walk the people on the webinar through this, Carlton?
Yeah, so I think what's kind of neat about this is that you can plug in any stock universe you want. In this case, I put in the Russell 3000, but you could do the S&P 500. You could do other I think we have value, growth, other different universes that you can screen for. And then I decided to do very bullish stocks. And as I think I mentioned to everybody on the call, free cash flow was something that I wanted. I decided to go for free cash flow stocks that are particularly strong, ultimately with price levels on the technicals that are somewhat oversold. And then I said, you know, in my portfolio, I've always been more of a mid and large cap money manager. I'm comfortable with a lot of the names. It was just an area of the market that I thought would be a good spot for me right now. And this is the screen. This is actually the screen from today. And interestingly enough, both Applied Materials that are in my portfolio and Cigna are both on this list. And Cigna obviously with a recent buy signal. So a lot of these signals persist, which is the other thing that I think is really elegant about the solution, is that it's not something that you would necessarily find that you're going to have to constantly whip around your portfolio. You can find your spots and look for the pitches, as we mentioned, and see that a lot of these factors wind up persisting for quite some time.
And that's because trends persist in Wall Street. Earnings surprises lead to analyst estimate revisions and so forth. So let's speak to the specific topic of today's webinar, using sectors and ETFs to allocate client assets. We have a very simple three-step process. Look at the Select Spider sector ETFs through the lens of the Chaikin Power Bar, and we'll tell you what that is. Drill down on strong sectors to make sure that the chart validates the fundamental potential, and then to give a portfolio additional alpha, find the strongest stocks in strong sectors, the sectors with the best fundamental potential. And this is meant to reinforce the concept that group strength or weakness, sector strength and weakness plays an important role in future stock returns. Between 50 and 60% of a stock's return can be attributed to the sector or industry group that it's in. And studies from people like Zacks, Standard & Poor's, Investors Business Daily have documented that strong stocks in strong sectors and industry groups have a tailwind, and that obviously helps profits on the long side. But if you're trying to bottom fish or go long weak stocks in weak industry groups, you're facing big headwinds and makes it so much harder to make money in both ETFs, industry groups, and individual stocks.
And it goes back to the trend is your friend. I know there are a lot of euphemisms around you can't change the wind, but you can adjust your sails, and other ones that we've used. But there's no question it's best to try to find stocks within groups that are already in an uptrend and allow you to get the tailwind that you speak of here, Mark.
And here's how easy it is to do a top-down analysis, which, as you know, is the way most institutional investors start their investment decision-making process. We've ranked the 10 Select Spider sector ETFs, and this is updated nightly, based on what we call the power bar. The power bar is the difference between the number of stocks with bullish versus bearish power gauge ratings. So it's a way of summing up the fundamental potential of a sector or an industry group or any list of stocks, could be the S&P 500. So in this case, we've got 6 sectors out of the 10 with power bar ratings that are positive and better than the S&P 500. You have 100 coming into today at 102 stocks in the S&P with bullish ratings, 89 with bearish. So at the top of the list are utilities. I'm not a big believer in utilities because earnings growth is slow and their ability to raise dividends is limited. And even though it's at the top of the list, I'm going to focus our comments on technology and healthcare in terms of very bullish sectors, and then energy in terms of very bearish, which is at the bottom of the list. And then right above that are those interest rate sensitive stocks, the real estate and the consumer staple stocks. So this is a very quick, fast, but powerful way to go beyond price momentum. We do want to see the confirmation of price momentum and the fundamental potential, but zero in on what's going on under the hood in terms of sector and industry groups. So here's what the XLK, the Select Spider Sector Technology ETF, looks like. 20 stocks with bullish ratings, 9 with bearish ratings. So a preponderance of stocks with bullish ratings. Relative strength was strong going into the election. You got some profit taking in technology after the election. Nobody's come up with a good reason for that I know of. But then again in January, both relative strength and Chaikin Money Flow show that big institutional money was flowing into this large cap exchange traded technology ETF, and it's continued to make new highs. Here's an example of one stock in the large cap energy sector that's been on a tear. This is Lam Research.
Yep,
technology.
Yep.
Sorry, and I think this is a stock that's also in your portfolio, isn't it, Carlton?
It is, yes.
So what we're looking at here, we started out with a 5-year chart just to get a sense of what really is powerful in terms of Lam. 16 straight quarters of positive earnings surprises. But in spite of that, the stock was in a sideways trend for over 18 months. It broke out of that trend the beginning of 2016, and this is what the stock looked like when it was breaking out. This is actually in the spring of 16. The stock was trading at around 85, and we got a bullish personality change. It went from underperforming to outperforming. It broke that long-term downtrend line, which was very easy to see. And since then, it's been outperforming the market. So we're going on 12 months of outperformance. So this is not a trading tool. This is an investment tool. Can be used by traders. Money flow has been strong. The power gauge has been bullish. There's your fat pitch, your ideal setup. And why don't you speak to when you got into the stock, Carlton?
Well, that was one of the ones that I got in January, and I don't see the bar below. It's just blocked here, but on mine. But back there you go. You can see that there was a buy signal on that because it was an oversold buy, and you know it was one of those things. As you say, the market was agreeing with the model, and everything was coming together. So it wound up being one of those that between the free cash flow that I looked at and other things that were screening, it came up in the screening tool. And it's nice to get a little fortunate, but if you have a discipline and you have an approach and you have a plan, somehow the harder you work, the luckier you get. So if you have the right setup and the right things and the right tools in place, you can find yourself putting your portfolio in the right direction right from the outset.
And just to show you that you don't have to be a successful portfolio manager with 25 years of experience running a mutual fund, my wife Sandy, who has become an incredible trader and investor, bought the stock right here at 125 ahead of this earnings report because she saw that 5-year chart in a previous webinar that we did and said, we've gotten oversold, the power gauge is bullish, money flow is strong. So she bought the stock, got another positive earnings surprise, and she was able to get out of this in the mid 140s because she felt that this was a gift from the gods, and she took that 12 or 14% profit over 5 days and was very happy with her about 8 days. So both successful institutional investors advisors and self-directed investors are using these tools profitably, and obviously as a professional investor, and most of the people on the webinar today are, you can do that as well. Now, here's the healthcare Select Spider Sector ETF, XLV, and we see a different picture than we saw in technology, in that, as we pointed out earlier, healthcare has been underperforming until just recently. So when a sector and an ETF is underperforming, typically I'm leery about buying it. But I look here and I see that institutional investors are heavily accumulating that healthcare ETF. So in periods like that, rather than buy the ETF, so when we looked at the XLK, you could have bought the XLK, but then you could have zeroed in on the strong technology stocks within the XLK to add additional alpha to a portfolio. When an ETF is underperforming but is under accumulation, and the power bar is bullish as it was with the XLV, I want to look at the strongest stocks in that industry group or sector. So in this case, if we had been looking back a month or 2 or 3 months ago, as Carlton pointed out, you would have seen Anthem Health, you would have seen Cigna, both stocks that are in Carlton's portfolio, because he's followed this discipline. So if the ETF and the sector is outperforming the market, that's a great way to allocate client assets, especially if the money flow is strong, indicating institutional buying, because it's an easy way to get exposure to the large cap sector in this case. If it's underperforming, I'm going to gravitate toward the individual stocks and find a stock like Cigna or Anthem, United Health, and zero in on that. But we also have another level down in our list view, which are 20 select spider sector industry groups. They call them subsectors. And this is the power bar ranking as of this morning: home builders, healthcare, software and services. Since we're talking about healthcare, 19 stocks with bullish ratings in the XHS, which is the industry group healthcare, only 4 bearish. This is what the chart looks like. I think we left the chart out. Here's the chart. Well, we're going to find out the chart of the one of the stronger ones. Now that you know healthcare is where you want to be, you can use our ETF screening tool to rank healthcare ETFs by performance. In this case, I've chosen 6-month performance. Could have chosen 1 month, 3 months, 1 week, but 6 months seems like a good way to judge the staying power of an ETF. And I see over 10 healthcare ETFs ranked by 6-month performance, but we also show you the power bar. So the one on top, the XHE, only had 12 bullish and 12 bearish stocks. And then when I looked at it to get some granular idea of what the assets were and the liquidity, I didn't like it because it only traded about 12,000 shares a day, whereas the IHI, the medical devices ETF, has 11 bullish and 7 bearish stocks. It's got $1.3 billion in assets, trades 130,000 shares, has a low expense ratio, a lower beta. It's been outperforming the S&P. So the next thing that I do is to look at the price chart, and I see indeed outperforming, positive money flow, making new highs. Obviously want to buy this on dips or look at some of the stronger stocks in the group like Brucker, which had a positive earnings surprise and a spiked higher, and TMO and so forth, Abbott, Baxter doing very well. So 2 different ways to benefit and create alpha. If the ETF is performing well and it ranks high, relative performance, so you got the combination of fundamental and technicals, that's ideal. Then you can find the best stocks within that. Now, we talked about what to avoid, and that's really playing good defense. Very often it leads to good offense because you can use that money in stronger sectors in the market. And the question comes up on webinars like this: can Chaikin help me in a bear market? You know, we've been in a bull market for 8 years and 2 months. But inevitably, there will be a bear market. This is what a bear market looks like. This chart was developed by Richard Wyckoff 92 years ago. He was one of the great market strategists and technicians of his day, and he developed this idealized way of looking at how a stock trades in a bear market when it's in a distribution phase. And I think you'll agree that it's pretty painful to live through that. So the answer is yes, Chaikin can help you in a bear market, and the proof is that energy, and we're looking here at the XLE, a 5-year chart of the Select Spider Sector Energy ETF, the large cap ETFs in the S&P 500, was in its own bear market from July of 2014 through the bottom here in 2016, down 50% from 100 to 50. I think we'd all agree that that was a bear market. You had a bearish personality change, so you can get them in ETFs as well as in stocks. And that was a pretty painful period, as we saw the average stock in 2015 in the Russell 3000 with a very bearish rating down over 17%. Now here's one of the darlings of the energy sector, Kinder Morgan. It held up a little longer than the sector itself, but the power gauge was bearish as Kinder Morgan was dropping from 42 down to 10, where it ultimately bottomed out. And this is what Kinder Morgan looked like on a 1-year chart. Power gauge went bearish conclusively starting in late February, but conclusively in May, excuse me, with a bearish personality change, started underperforming the market at $40. And look at the institutional selling that started coming into the stock all the way down. And it started triggering what we call our overbought sell signals when it rallied up, made a new 8-day high. Money flow stayed negative, telling you the institutions weren't buying into those relief rallies, and chance to get out of the stock or establish defensive positions on the short side or with put options on the way down to an ultimate bottom at 10. This chart ends in, I think, January of 2016. The stock had more to go on the downside. So yes, Chaikin can help you in a bear market. Now let's look.
The other thing that I find interesting about these things, Mark, is that a lot of these kind of phantom bear markets that occur within the broader market have occurred relatively frequently. I mean, I think a number of the people on the webinar probably had to live through the tech wreck of 2000, 2001, and even in that market, if you look back, it was largely the technology stocks, some of the more value stocks, whether it was financials, staples, some of the other areas of the market actually held up reasonably well in the technology debacle. And here we've got a case where I think if you had avoided just simply being in the energy stocks in 2015, you could have had a reasonably good year.
I agree, and unfortunately, energy is in another negative phase here. We had a bearish personality change a few months ago. The XLE was trading at 72, recently bottomed out at 66. The price of crude has turned up a bit. So here again, with the market making new highs, energy has been a bad place to have client assets allocated, and some of the largest and better known energy stocks, in this case Schlumberger, have taken it on the chin. Schlumberger has dropped from 82 to 70, so better than a 15% drop, while the energy XLE went through that bearish personality change. Had the same thing happen in Schlumberger. Sell signals along the way, negative earnings surprises. We actually highlighted this on a webinar back here in April when the stock had rallied up to $80 from a low of 76. You got a bearish earnings surprise and you made that ultimate low at $70. This is what playing good defense is all about. So if you're building a sector portfolio, do you want to be in energy or technology? Do you want to be in healthcare or consumer staples? Go where the fundamentals are best and where the technicals are confirming it. So Carlton mentioned our discovery engine. We're going to end the webinar on that note because this is a very powerful breakthrough in finding stock ideas that are customized to your preferences, to the stocks that you're familiar with. So the discovery engine enables you to seed it just like Pandora or Spotify or Netflix does with a stock that you either like or hate. In this case, for a webinar that I did on March 30th, remember we were looking at Under Armour as our classic Chaikin bear. I seeded it with Under Armour. And I got 5 stocks with very similar characteristics to Under Armour, mid-cap apparel stocks with bearish earnings estimate trends, classic bears. And I immediately spotted Lululemon because they were due to report earnings 2 days later. I could have been looking for swaps, and the only other apparel stock was Skechers, but I zeroed in on Lululemon on a webinar that I did. And Lululemon reported earnings the next day, and in spite of the fact that it had been acting poorly heading into the earnings, it rallied and then dropped 25% on a gap down opening. So the discovery engine enabled me to zero in on Lululemon when it was 66 and about to report earnings. Earnings came in a big disappointment, and the stock has continued to go lower. It's sort of basing here, but going nowhere right now. So this is the power of a very disciplined approach, combining an alpha generating model with a very contemporary way to find new ideas. We call it a relevance-based discovery engine, and it's helping us identify very strong candidates. So we've been looking at examples from Chaikin Analytics. We have the new discovery engine on options idea module for those of you who use options, stock screener, earnings alerts, news and intraday charts. Remember I said in the beginning, it's our answer to the information overload problem. It's all on one screen. You don't have to hop to FactSet or Morningstar. It's all in one place with an alpha generating model built in. So this is perhaps my favorite endorsement. Many of you know John Malden. He's a macro thinker. He runs a big conference at the end of May with some of the best and brightest minds all around the world coming in, talking about their macro view. And John has a macro view. And he's gotten hooked and hooked his whole analytics, his analyst team on Chaikin. And they use it to vet their ideas in their newsletters. And since they started using Chaikin, their Rational Bear newsletter has zeroed in on Avis, which has been a very, very weak stock in Chaikin. They had a bearish strategy they put together based on that. And John has been very impressed and really mandated that the Malden economics analytics team uses Chaikin to vet their recommendations before they make them. So Chaikin Analytics for iPad and desktop. This is sort of the pitch to those of you who've gotten excited about this approach and this tool and how it can help your practice and save you time. Normally $1,950 a year. As a webinar special, we're reducing the price by $200. The offer is good through Friday, May 12th. ChaikinAnalytics.com/wealth or the number that's on your screen. If you have any questions, you can email them to sales@ChaikinAnalytics.com. And along with what you've seen, you get 2 market letters. John Schlitz's Daily Morning Insights comes to you before the opening, and my weekly market letter called Chaikin Market Insights that comes out on Sunday. We'll talk about what's happening in the market, where it's likely to go, analyze group and sector trends, and have a bullish or bearish stock of the week. And most importantly, small group tutorials to help you get set up, understand all the functionality, what the benefits are to you and to your particular investment style, how to use all of this to basically simplify your life. Now, as a further inducement to subscribe to Chaikin Analytics, a webinar special, $100 off if you subscribe by midnight tonight from the already reduced price, reducing it to $1,650 a year for an annual subscription. Go to ChaikinAnalytics.com. That should be wealth, not profits. Sorry about that. And that $300 discount will be pre-populated. With that, I'd like to thank my colleague Carlton Neel, who's getting better and better at this, probably better than I am because he speaks from real world portfolio management experience.
Well, it's always great to be on with you, and thanks for the nice comments. I would just also say that the help desk, even though it's just a walk for me rather than a phone call, has been just absolutely incredible in helping me learn the tool even better. I think most of the people that are on the webinar are market pros, so a lot of the jargon is pretty obvious to them, but if there's anything that anybody needs, the help desk has been there. It's been great for me. It's been allowed me to get up curve on the system very well, and it's just been a thrill to use it. So thanks for having me on, Mark.
It's my pleasure, Carlton. With that, let's turn it back to Joe Bicella, who will wrap it up, and make sure you cover up from my mistake there and not not putting wealth in there instead of profits.
All good. Well, thank you so much, gentlemen. I already saw a few comments coming in. Excellent presentation, and I fully agree. So as Mark just mentioned, chaikinanalytics.com/wealth. You can see the code. I just wanted to pull up the checkout page just to confirm. If you go to chaikinanalytics.com, again, /wealth. I chatted that out to everybody a few moments ago. Another question I saw is that this is an annual subscription, just one time, one payment for a full year's worth of access to Chaikin Analytics. It'll take you right to a checkout page just like this. A few last reminders: we are recording today's session. But also important is we do provide a whole bunch of support webinars just for our own subscribers. We do a lot of work with ETFs. We host pre-market sessions on Tuesdays and Thursdays, and you can check out the recording of the session that we hosted this morning if you take advantage of Mark's offer here. Final thing, we have a webinar taking place tomorrow, an onboard session for our new subscribers. Again, one of the many reasons to take advantage of the discounted offer from Mark and Carlton here today. So again, chaikinanalytics.com/wealth, or you can give us a call, 877-978-6257. Thank you all for the questions throughout the day. Hopefully I was able to get to just about all of them. In the meantime, have a great afternoon. Keep an eye out for the recording. We're going to email this out to you in a few moments, or probably later on this afternoon. But in any case, have a great day, and we will see you on tomorrow's onboard session.